Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. Today's stock analysis report will feature 3 stocks from the United States steel industry, 2 of which are leaders in one of the fastest growing segments of the U.S. economy. The steel industry has many stocks not trading at their full potential as we see growth across the economy start to slow. But that's exactly where I see the opportunity. As of right now, next year is projected to be a rebound for the steel industry, and these are 3 stocks that I believe are low-risk holds heading into the next 24 months. First on the list is Nucor. That's ticker symbol NUE. Over the past 5 years, their sales have grown by 11.6% on average. Despite having the lowest projected growth rate of the group, they have the most potential upside to the average analyst target. Analysts have the company priced 25% above where they are right now. I believe analysts have targets well above the current price because of the company's above average operating margins, high free cash flow yields, and extremely strong balance sheet. Nucor has a current ratio of 4, meaning the company can cover their current liabilities 3 times over and still have cash in the bank. On top of that, Nucor's operating earnings yield ranks above 81% of the 4,000 companies tracked by Ford Equity Research. This further establishes the likelihood that the company can add value to investor portfolios. Next on the list is U.S. Steel. That's ticker symbol X. Currently, the story surrounding this company is the potential acquisition by Nippon Steel out of Japan. If that acquisition goes through, it will almost certainly be above the current price. But that's not the only reason to buy and hold U.S. Steel. First, along with Nucor, U.S. Steel is listed as one of the leading steel companies making moves in decarbonization. The market for green steel is projected to witness a compound annual growth rate of 113.6% from 2023 to 2032. 2 years ago, the market for green steel was $200 million, but now it's projected to be over $365 billion by 2032. U.S. Steel has seen sales growth of 13% on average over the past 5 years, and their earnings are projected to grow by 8% per year over the next 5 years. Their operating earnings yield ranks above 86% of the 4,000 companies covered by Ford Equity Research, and the average analyst target projects the company has 17% upside from the current price. PVGO metrics also show the company as being priced for 5% growth over the next 5 years instead of the 8% growth they are likely to achieve. This supports the average analyst projection that the company is likely underpriced. Last on the list, but not least, is Steel Dynamics. That's ticker symbol STLD. This is one that I believe the analysts have wrong. The company is being priced based on its lackluster 2025 earnings projections, but I don't believe consideration is being given to their more than stellar 5-year growth projections. This company is projected to have the best earnings growth rate of the entire group, with a 28% compound annual growth rate over the next 5 years. So although the average analyst has them priced closer to $138 per share, I have them priced closer to $155 per share. And I believe the market value of Steel Dynamics could more than double over the next 5 years. They've also seen the best revenue growth over the past 5 years when compared to the other 2 companies in this episode, giving them the best Rule of 40 rating in the bunch. Their current ratio sits at second best behind Nucor at 2.87, and their interest coverage is at the top of the pack at 48.37. To top it all off, Steel Dynamics has the best return on invested capital of the 3 companies in this episode. Similar to U.S. Steel, their operating earnings yield ranks above 86% of the 4,000 companies covered by Ford Equity Research, further shedding light on the potential undervaluation of the steel industry. Some of the risk taken on by investing in the steel industry include the current strength of the US dollar, which is currently depressing the price of all commodities outside of crude oil, the potential that interest rates remain higher for longer than expected, which will continue to dampen capital spending and thus lead to longer than expected underperformance in steel, and the potential for a recession in the United States. Although most analysts have ruled a recession out of their forecast for now, recent reports have shown that the U.S. economy is slowing more rapidly than expected. The longer interest rates remain at these levels, the higher the probability of a shock becomes, which would most certainly lead to these stocks trading at lower prices. Whatever the outcome, these are still some of the best valuations money can buy. If a recession were to come about in the U.S. economy, these companies are more than equipped to handle the downturn and should recover very quickly as the Fed responds with credit policy to stimulate growth. The Equity Channel is one of the most followed stock market podcasts for beginners, a valuable resource for investors who are looking for information on the stock market and the economy. We love to make our episodes quick, straight to the point, and rich in value. We hope that's what you got today. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.